Hey everybody, welcome back to the Grad-Centric Podcast. I am excited to start a new series on student loan planning. Student loan planning is important not only on the front end of college to figure out how you might pay for a college experience that's increasingly more expensive, but also on the back end with paying off that debt. So whether you're a student coming out with student loan debt, federal or private, or whether you're parents that have taken out a Parent Plus loan, all of these are important conversations to have to maximize not only your ability to get an education for good earning potential going forward, but to maximize your ability to pay off your debt in a way that makes sense, right? Whether trying to figure out interest rates or repayment plans, things of that nature. And of course, we're also going to cover some really important topics on loan forgiveness, repayment plans from the federal government that can be really lucrative and important for managing your student loans, especially if you have high balances. So lots of great topics there. Okay, so what do I want to start this series off with? Well, let's talk about AGI. AGI means adjusted gross income. And how can you find your AGI? So your AGI is going to be on your most recent tax return. You can find it there. And of course, this isn't a tax podcast, so we're not going to get into the specifics there. You can look on or Google, I guess, how to find your AGI on your tax return and what line it would be. But we're going to talk more in generalities here about your AGI. So your adjusted gross income in many respects is just your total income minus some deductions that are given to you by the government in terms of taxes. So AGI. Now AGI is really important for federal student loans if you're in an income-driven repayment program. And like I said, I think I've already done a blog at gradmetrics.com about different repayment plans, but income-driven repayment plans are going to be tied to your income and also tied to your family size. So AGI is something that factors into that calculation to calculate your monthly payment. So why is this important? Well, I think it's important for one of two reasons. The first is there are a lot of borrowers out there that are just getting crushed with student loan debt. Maybe they took out too much, or they went to a graduate program that required a lot of borrowing, and so they have very high monthly payments. So many of these borrowers are wanting to figure out, how could I maybe lower my monthly payment? And of course, an income-driven repayment plan can be a solution there. Not only that, but once you're in an income-driven repayment plan, then lowering your AGI will also lower your monthly payment. And so if we can lower AGI or figure out smart strategies to lower AGI, that can accomplish the goals of these borrowers. So AGI can be very important from that aspect. Now, what's interesting when we talk about AGI and student loan payments is lowering AGI, at least in a smart way, can serve two different strategic goals. So a lot of times these individuals who are also wanting to lower monthly payments have goals like saving for retirement or putting away money for medical expenses, or maybe a baby is on the way and they need some extra money there because insurance isn't going to cover that much. So lowering AGI, if you think about it from those long-range goals, you can actually lower AGI by contributing to retirement accounts, for instance, or contributing to an HSA in certain scenarios. And so if you're working with a financial advisor or a CPA around some of these smart strategies to save you in taxes or to plan for the future, a lot of times you can kind of double dip here. Lower your AGI by doing some of these long-range planning things, but then also getting the low AGI for those monthly payments. The second scenario, to get back to kind of my initial thought here, the second scenario that the AGI lowering might be important is if you're going for long-term loan forgiveness. So a lot of borrowers are thinking about public service loan forgiveness. or they're thinking about long-term loan forgiveness in terms of just being in an income-driven repayment plan. A lot of times you'll get forgiveness after 20 years or 25 years. So if you can lower your payments on your way to loan forgiveness, that will save you on the total cost of the loan. So that's also a strategy to look at here. Anyway, if you have any additional questions on AGI or how it plays into student loans, please let us know. You can always email us at contact@gradmetrics.com, or my email is jason@gradmetrics.com, and we'll talk to you there.